Question 30. Alpten Company acquires all of Dulux Company's assets and liabilities for cash on January 1st, 2018, and subsequently formally dissolves Dulux. Okay, so this is the keyword. They are going to dissolve Dulux. At acquisition day, the following book value and fair value were available for the Dulux Company account. Okay, so the subject company have assets, liabilities, land, trademark, and also there is a goodwill of 15,000. 15,000 is the book value, and also have liabilities, common stock, and return earnings. Question is to prepare Alpten's entry. Alpten is a sub-parent company, so the parent company needs to prepare entry to report its acquisition. Assume the following cash exchange accounts amounts. Okay, so to prepare the entry to record this acquisition for the parent company, first we need to know whether there is a goodwill or a gain on bargain purchase. So, which means that we need to start with how much they paid and how much the parent company paid, how much the parent company acquired. So total consideration transferred in this question is 145,000. The number is given here directly. And the next is, what is the fair value of the net identifiable assets? So that's what equal to the fair value of their total assets. That's the fair value of their total assets, and minus fair value of their liabilities. So there's one thing here that we need to pay attention is this goodwill. And when we calculate the fair value of net identifiable assets, we ignore the subsidiary company's goodwill, and because they are not identifiable about what they are. Okay, so then let's calculate what the fair value of those identifiable assets that equals to the fair value of its current assets plus building plus land plus trademark. So those are the identifiable assets, and then minus the fair value of their liabilities, we get 120,000. So next, let's compare the consideration transferred and fair value they acquired, and we see that because they paid more, and then which means that parent company need to record the goodwill. So goodwill equals to 140,000 minus 120,000 is equals to 25,000. 25,000 is the goodwill. So next let's prepare the journal entry to record this acquisition. Remember, the keyword here is that the Dulux, the subsidiary company, the parent company is going to dissolve the subsidiary company, which means that subsidiary company is going to cease to exist. Which means that we are going to transfer all the subsidiary company assets and liability to the parent book, and then the journal entry here is to debit all the assets and the liabilities. We're going to debit all those assets. At the same time, the parent company needs to recognize this goodwill and then credit the liabilities. Same time, they are going to credit this payment, this cash payment, 145,000. Okay, so this is the journal entry to record the acquisition. If Dulux, the subsidiary company, is dissolved, so it's dissolved. If Dulux subsidiary company is not dissolved, if they still operate independently, and then the journal entry would be quite different, right? And then if that's the case, then we're going to create an investment in the subsidiary company account. Okay, so but this is the journal entry if the parent company dissolved the subsidiary company.